Assalamu alaikum. This is going to be a case study about blockchains and bitcoins and similar cryptocurrencies and how they're going to change and shape our future. Hence, its title, The Future of Money. It's a case study by FaberNovel. I would highly recommend that you also listen to the audio lecture about bitcoins and blockchains. That's also on my YouTube channel, or listen to other lectures by similar people about blockchains and bitcoins, and definitely go through the case study bundle about bitcoins and blockchains. That'll help you better understand what we're about to talk about here. So it's assumed that you already understand how blockchains work and how exactly Bitcoin and similar cryptocurrencies actually function. So let's get on with it. Now, if we're talking about what exactly is money and its future, we need to first understand what exactly is money. Now, we understand that money is a common link between practically every aspect of society, be it the health system, the educational systems, the infrastructures. The impact of monetary policies is on everybody's lives. It's everywhere, right? So we need to understand that there is a lot of value in money. Its importance to every aspect of society, to every aspect of our economy, of our countries, everything. So the question is the value of a sovereign money something that we can still believe in, especially considering that a lot of countries are already in debt? So what would it mean to let individuals and corporations actually decide on the creation of money? Now, if you've obviously studied a lot of courses in economics, so you understand how money is actually created. So instead of having organizations, or instead of having a central authority decide on what is and is not money, what happens if we let people decide that? What happens if we let multiple corporations decide that? What opportunities could rise up if we decide as people to launch our own currencies, our own money systems? Or what happens if a corporation decides to do the same? How exactly would we handle something like that? So it's also because there are a lot of problems that we are facing today with respect to the way that money has been created and has been used throughout the years. Now, there's a lot of functionality within the software systems and through the use of cryptocurrencies and blockchains, that we could actually create a new form of value, a new form of money, so to speak, so that we can understand and use that form of money in a better way, so that we can solve the problems that all of those specific clusters that we just talked about, specific areas and aspects of society and economics, can be handled. Because if we are to continue with the kind of money systems that we already have right now, we're going to keep on increasing and exacerbating the problems that we have right now. So we need to create a new form of money, a new form of mechanism to carry value, so that we could include more people into it, so that it could actually give economic incentives to people and companies and would act more like a tool for the common good, more like an instrument to help people rather than to continuously indebt them into a mechanism that is completely flawed. Anyways, so what this entire case study actually posits is the fact that there could be an alternative to the kind of money systems that we have today. Hence the title, Future of Money. Now, as we know, and as we've already noticed, this audio recording has been made in 2020. We've gone through one of the most difficult times in recent history with regards to the economics of the world. Now, we've been hit with COVID. The entire world's been hit with COVID. The pandemic has devastated economies, has devastated the structure of our society, so to speak. So money as we know it has become extremely important. It is extremely important because the three aspects that it was designed to fulfill have actually become, they were always important, but now they are not just the only reason why money exists. So money initially was created to be a store of value, to represent some form of value, to be used for exchanging favors or exchanging resources. It was also designed to be a unit of accounting for some production or some work or some effort put in. Right now, however, it has changed. By the time that we are in 2020 and now in 2021, to be precise, we can see that it has now become not just these three things. It's no longer just a store of value or medium of exchange or a unit of account. It is also an instrument or a methodology through which we decide who rules the world's economy. It also decides complex social interactions. I mean, the way that we treat people who have and those who do not have, the way that we decide what people get and what they don't get, what access to other resources they can have and cannot have, and how interdependent and independent can political systems be in the presence of these money systems is something that we are quite aware of. So now the only reason that all of the money systems of the world as they exist continue to exist are based on the fact that people trust it. Any money system, any currency on the planet, any fiat currency. And when I say fiat currency, I mean the currencies actually used and issued by the central banks of different countries, different sovereign countries. All of them are completely dependent on very important factors, two factors. One, the trust that people have into those systems, and the institutes that actually issue them, and the trust that people have in those specific institutions, whether it be the government or the banks, the central banks, that are actually assigned that authority by those governments. Now, throughout the human history, the monetary system has actually reflected the way that our human economy has actually evolved. So if we start way back, if we take up ancient history, the oldest known item that we had, which has intrinsic value. Now, let me remind you what intrinsic value means. The coins that we go back in time and actually find out way back in the 600th century BC actually had actual value. They had intrinsic value. I mean, the metal that they were made of actually had value. It wasn't just value assigned. It wasn't just extrinsic value, as I just mentioned, which is based on trust, but rather it actually had intrinsic value. So the Lydian kingdom is supposed to be known to be the oldest known civilization that actually had a coin that they properly minted with a stamp of their government on it in 600 BC. Then flash forward all the way till 1685, and we can talk about money being a common system across the globe. The double entry system was invented in Genoa. The banking system was around 1000 AD. And then since then, we've been using them in one way or another. So in 1685, to be precise, the French authorities actually issued playing cards. Okay, so that was supposed to be used to pay soldiers of fighting in times of war. So it was like a stored value card, a way to represent money. Now, by 1971, which is when we start counting globalization as becoming common, the rise of international trade, which actually gave US its power across the globe, started happening. So at this point in time, the dollar gold convertibility stopped. This is the exact point in time in 1971 when the US dollar was no longer being backed by gold anymore. It is at this point in time that you could actually say that the US dollar was backed by nothing. Thin air, nothing. It's just dollars being backed by dollars. There is no intrinsic value backing it anymore. And that's an important aspect to understand. Most people still continue to think that perhaps the US dollars that the Federal Reserve Bank actually issues, which is the United States Central Bank, actually issues is based on some amount of gold that they possess, which is no longer true. After 71, it's no longer true. The entire world's economy is based on the US dollar, which in itself is based on nothing. Okay, so it's fiat. Anyways, so this is when things started changing. There was a lot of complexity happening. There's a lot of frequency and volume of money actually happening. And a completely new economy, a completely new way of understanding money has started happening. Because before this, the paper currencies, the notes that we had, were actually a representation of the amount of gold that the country possessed, right? But now after this day and onwards, it changed. So then moving on to the 2000s, after the World Wide Web became common, after the internet boom, first the bust and then again another boom, connectivity allows new value creation. We already know about the Web 2.0, we already know about social media, search engines, whatnot. We've gone through all of that during our course. It changed everything. And there was a lot of movement, a lot of bickering and talking about having more control over things around us, having more control over our own data, our own resources, our own value. Okay, so 2008, when the recession happened, the financial crisis of 2007-2008 happened, people had decided that enough was enough, and they realized that there is inherent flaws. There are several inherent flaws, to be precise, in our current money system. That is when the first research paper, the first paper on Bitcoin was actually published by Satoshi Nakamoto, and we will talk about it later. So in 2012, the Ethereum, another form of a cryptocurrency, was born. In 2019, crypto yuan and the Libra project by Facebook was announced. By 20 something, we don't know when, there's going to be some changes. The way that a new form of money that will show up, either it's going to be controlled by governments, either it's going to be controlled by corporations, or by individuals, or by a complex setup of all three. But something is going to happen. It's going to change. So we can see that there has been a tradition of change throughout history, throughout human history. It's a nice flashback. If you look at it, things have been changing since the intrinsic value coins of 600 BC to the stored value card process that started happening in 1685, right? To the change in the way that money was backed by something of intrinsic value to more extrinsic value. So one would ask, what happened after 1971? We just trusted the US government, and hence whatever promises they issued in the form of the US dollars was trustworthy. So there is no intrinsic value in whatever they're issuing anymore, and the world changed. So the way that it changed in 71, and the way that it changed in 1685, and the way that it changed after the internet, and the way that it changed when the first paper, the first white paper was actually published about bitcoins and cryptocurrencies, is the way that it will change again. Maybe. Let's see. So despite these continuous evolutions of our economy, the global financial system has still continued to serve the same three purposes that we talked about. One is emission, then distribution, storage, and use. So what are the three original functions? Let's look at it. Emission. Central banks across the globe, whether it be the State Bank of Pakistan, whether it be the State Bank of India, whether it be the Federal Reserve Bank of the US, whether it be the Royal Bank of England, the central banks control the entire process of issuing and printing money. Now, money being printed is not money being created. Money is created through debt, okay, leverage. But the physical form, the currency, represents that value that is owned or held by the economy of that country, which is sovereign. So they emit money, they create money, and they regulate that money, and they allow it to be circulated within the economy of the country. So their ultimate goal is to guarantee a stable value of that money. Each piece of paper that they stamp some amount on has certain value. So their job, the central bank's job, and the job of the global financial system is to make sure that there is stability in the value of money, and the people continue to trust it, and people continue to use it. Then it's distribution. Then comes the second layer, the private banks. The private banks guide the flow of newly created money to economic agents, companies, individuals, other people who are borrowing that money, who are going to use that money to create new factors of production, to create things, to create new property, intellectual property, physical assets, everything. So they execute a function that they're delegated to, which is to make sure that they feed and finance the economic growth of the central bank. How so? By letting you borrow money, which in turn creates more money, by creating new financial instruments, credit cards, debit cards, checks, investments, insurances, all of that. That is distribution. Then comes along the storage and use. So economic agents store their currency in private banks, like individuals do it, companies do it when they invest in some products, in some financial derivatives. They also act as exchange intermediaries. So they allow you to transfer money from one form to another, from M2 to M3, from M1 to M2, right? All the forms of money. So they safeguard individual currency ownership and facilitate investment in the economy. So these banks help us. By whenever I want to spend some money to get a new car, I get a lease, I pay in installments. That money goes into the bank, it's invested elsewhere. Someone else is making use of it. I get an insurance, I keep on paying for it. I get some amount in return whenever I need it. The bank uses that money and creates a new product. Somebody invests in that product, so on and so forth. That is how the economy works. So these three functions that are at the foundation of this entire economic system have a lot of impact on people's lives. As it's obvious. I mean, it cannot be considered that there is going to be no impact on people's lives when these things happen. The emission has a huge impact. How so? Imagine what happened after World War II. After World War II, a lot of world's economies and sovereign countries were devastated. So the Hungarians, after World War II, were actually burning their own currency notes for heat because there was so much hyperinflation, which is the value of their money was practically zero. It was useless. It meant nothing. So after World War II, the Hungarian government actually abused their money printing powers. They kept on printing more money because they needed to have more money circulated, which basically caused the money or their currency to be inflated. So there was a daily inflation rate of 200%. So in 9 months, in just 9 months, the total value of all Hungarian banknotes in circulation was just worth $0.001. It was worthless. It's probably less worthy than the paper that it was representing. So yes, it had a huge impact. So if you go back again, if the central bank does not do its job, if it doesn't keep the value of money stable, then hyperinflation happens. Number two, distribution, which is where private banks come in. Now, Wall Street investors after 2008's subprime crisis. Now, if you want to go and understand this better, you should definitely go and watch the documentary by Matt Damon, which was called Inside Job. It's amazing. It was Oscar nominated, it's an Oscar winner. It's amazing to understand this. And there are several explanatory videos on YouTube available for this as well. Anyways, so what's the job of the private banks? The private banks' job is to make sure that they give new ways in which people can invest money. So in short, what happened during the subprime crisis was the banks created new investment offerings, which were basically derived from people taking mortgages for their homes. Now, when people would borrow money, they would return that money, and out of that, they created different new, financial derivatives that were then used as investments. So earlier on, the banks were giving out, investment opportunities into these contracts that were actually pretty good. I mean, they had good high ratings. I mean, they were from people who were returning the money or paying installments on time. Later on, the banks became greedy. The investment banks became greedy. And they decided to, even give out investment plans backed by not so great mortgagers and leasers. And then eventually a crash happened. And that was known as the 2007-2008 crisis. So the Federal Reserve Bank, as it's called, the Fed, the US central bank, actually had to inject about around 1.3 billion, 1,300 billion. Is it? Yes, 1,300 billion in the private banks. And a few years later, most of it, 70 to 85%, has been absorbed by the financial spheres of the economy with very little impact on small business. So they had to actually give out money to the banks to survive because the private banks had no money to keep on circulating and to keep on distributing that people wanted because value was just wiped out. As I said, it's not intrinsic, it's all extrinsic. It's what people believe in. So once this crisis happened, the values and the money was actually wiped out. It was gone from the system. There was no value because there was no trust anymore, and it all came crashing down. So the central bank had to invest a lot of money into these private banks, and yet despite all of that, the small businesses that actually had suffered the most because of that crisis got nothing. So this is what happens when they are unable to feed, finance, and economic growth. That is the job of private banks. They are unable to do that. If they're not able to create stable and sensible and actually efficient ways in which that money that is being issued by the central bank and is being consumed by the individuals and by corporations is actually not distributed properly, this is what happens. The 2007-2008 crisis. Anyways, moving on. Then comes the storage and use. So what is the storage and use? Now, the true money ownership, is that people actually will need to store that money somewhere. So who actually owns that money? So fractional reserve banking, which is 10% in the US, makes it legal for banks to keep only a portion of people's savings at their disposal. Okay, so only a small amount of money can actually be taken out by us. I've mentioned it earlier in multiple lectures. It's approximated that around 97% of the world's wealth is actually they're just stored numbers in a computer, in several computers across the globe. Only 3% of money is actually in circulation. And there isn't enough paper and plastic and trees in the world to actually print all the world's wealth if people were to go out and start withdrawing it. So that's what happened. People were waiting in lines for ATMs in Greece after the crisis. They wanted to have cash, but they couldn't. So it is encoded in the roots of our system that ownership of money is transferred from people to financial institutes. So we don't even have that cash in our hands. We don't even have that money with us. It's actually in the system. So we don't own it. technically speaking. I mean, it is ours, but we don't really own it. We don't really carry it all the time. So, currency ownership that would facilitate investment and use is something that is the responsibility of private banks and the people involved and the people who are actually creating that exchange and creating new opportunities. And they're not there either. So, all these three basic functions, emission, distribution, storage, and use, have a huge impact if they're not done right. So to help the US economy recover from the COVID-19, the Fed had to do something similar again. This time, they had to actually give out a stimulus of about 6 trillion US dollars. That's a lot of money. So the Federal Reserve actually had to do that. So experts expect the impacts of COVID-19 crisis on the US economy to be even worse than the Great Recession, which happened in 1917, 1919, the first depression, right? The Great Depression, as it's called. The country already counts around 16 million newly unemployed people. So by 16th of April, there were 16 million unemployed people in the US alone. Why is it important to us if the US suffers that way? Because the US's dollar is based on the trust that people have on the US government, the US, power, right? And if the US dollar becomes weaker, all the world's currencies and all the world's money is actually based on their US dollar. So if that goes away, they all suffer. So it's very important for everybody that they don't. So to reboost confidence in the market, the Fed has announced has multiplied its announcement since March the 3rd, and the total is around 6 trillion, as I said. So it's a huge amount. Never in the history of mankind has this huge of an amount, actually been issued by the Federal Reserve Bank into the economy to keep it running. So they had to do that. Why? Because this is the problem. So there was a misappropriation of funds to pay back debts, right? So people were saving up in the short term. There was increased saving fuels, speculative placements in a down economy. Increased saving actually caused a problem. It caused a problem because of the speculations. So people were saving up. When people were saving up, there was a lot of speculation happening, and people just weren't investing in it because people had this uncertainty because of COVID. Nobody was spending money anymore. They were just keeping it. So inflation risk on primary commodities. There was a lot of rise in the prices because of the value of money going away. Even in the basic things, in basic commodities, edible items especially. So long term, there's everybody tends to think that that the system is just too big, so it won't fail, and that leads to a lot of bad decisions, and that's the long-term impact that's going to happen because of this 6 trillion. So just because the COVID is going to go away with the vaccines coming in doesn't mean that things are going to change. The world's economy is going to continue to suffer for many years because of this. So the nature of fiat money actually makes it impossible to control, and it creates a lot of interconnections between industries that needs to be protected, that are necessary. So, but the way that the fiat currency works, and to remind you again, fiat means to be, or in Arabic as it's called kun. So fiat currency is all the currencies that are all the monies that are issued by the various central banks of the world and the world's countries. So this is made out of thin air. Fiat, which means to be ordered, to be. Okay, so fiat money is the link between all of these important aspects, these clusters, as FaberNovel calls them, these clusters of society and economy. So it's health, it's education, it's infrastructure, it's industry, it's financial markets. It's all the major elements of any country, of any sovereign nation. So the fiat money actually acts like a link between all of these commodities and all of these services. It allows economic downturn to turn into a systematic crisis because everything gets affected, because everything's affected by money. If there's not enough money in the systems, doctors don't get paid. If the doctors don't get paid, they are unable to use that money to fulfill their own basic needs. Then the health system suffers. If there's not enough money, if there's not enough resources, the educational sector suffers because it's unable to provide the necessary services to its children, to its students, to its teachers, to its staff. And a nation that doesn't learn is not ready to take on the responsibilities that their earlier generation will then give up once they're dead. The same is true for infrastructure. If it's not present, then we cannot really function. Industry, there's no manufacturing possible because the money is not there. So the post-COVID crisis in the US is leaving a lot of people without any kind of health insurance because they had to cut that down. People couldn't afford to continue to have insurances. The country couldn't afford to give them, national level, care like the Obamacare program, which was basically, asking the Americans to pay taxes so that when they're older, the government pays back to them in the form of health insurances. So they don't even have healthcare support because they don't have enough money saved up, because they couldn't afford to save it up because they were spending that same amount for basic commodities. So with fiat money, financial aid is impossible to control. You can no longer direct it because of the way that the fiat currency is actually created. The fiat money, is created. There is no way that you could control the way that you help people with that money. That financial aid can be given. So with private economic agents naturally pursuing profit responsibility, responsible for money distribution, financial aid is hard to direct towards the most fragile clusters of the economy, because these banks, these private banks, and these elements of an economy that are out there to make profit are only going to look at profit. They're not going to spend that money to actually aid a particular cluster of the society, whether it be health or education or infrastructure, industry or financial market, and so on and so forth. Their only primary purpose is to make money for themselves, right? So these clusters are connected with the creation system of the central banks, with the private banks in between. So what I'm trying to drill into you or make you understand is that there are too many elements, there are too many intermediaries that are involved, and that restricts the amount of money or an amount of value that is actually reached to by these clusters. They don't have the money to continue to function, and the banks really don't care. The private banks don't care because they're out there to make money for themselves, for profit. So there's this quotation by Raghuram Rajan, who's the Indian Central Bank's governor, regarding helicopter money in 2016. He says, somebody getting this money and seeing the central bank governor throwing this money out of the helicopter, saying, is this guy crazy? Has the world gone nuts? I'm going to save this because I'm not sure what is going to happen, right? So this is with reference to money being thrown out of a helicopter, and apparently because if somebody's going to just like throw it out, I mean, that's what good people are going to say. People, when you go out and you throw money out of a helicopter, or that's what people are going to say. So they're going to say that that guy's just crazy. They're nuts. They're obviously going to be like, that gives a very wrong impression. That gives the impression as if something bad's about to happen, and anyone who sees someone else throwing money out like that is going to just collect it and keep it, and they'll be like, you know what, I'm going to save this because something bad's about to happen and I'll need this money for that purpose. Anyways, so when financial institutes start losing the trust of people, then people start to look for other possible ways in which they can save money, other possible places where they can store their value, where they can trust it. So people do all sorts of odd things. People fall into other kind of traps and start looking at other alternatives, and some of those alternatives are pretty viable. They make sense. I mean, people are going to try and save the value that they have so that they can use it to get their commodities and their basic needs and even their higher needs. So during times of economic instability, whenever currency is hyperinflating, people start to lose trust in their government. When they lose trust in the government, they lose trust in the central bank that is actually empowered by their government. And that means that people start saving up in some other form. So this reflects on the evolution of black market exchange rates, why people, and shows the risk that people are willing to take because they want to save their value, whatever money that they've earned, whatever savings they have. So in times of uncertainty and doubt, people's trust is very volatile and can easily crumble. So multiplier of dollar and local currency exchange rates between official and black market rates. So in Argentina, the rates were like 1.1 times more, but people were willing to invest in the black market instead of the white one. In Algeria, it was 1.4 per times. In Venezuela, it was 10 times. In Zimbabwe, 20 times. So for instance, after the various political crises that happened in Venezuela, the Venezuelan citizens did something crazy. When they saw that within 98%, you must have seen pictures on Facebook where people have actually thrown out the Venezuelan currency, the bolivar, and they actually threw it out on the streets, because it lost its value. There was hyperinflation. So where would they turn to actually save their money, because they lost trust in their own country's currency, in their own money. So what they did was very crazy. They actually went in and they bought in-game tokens in Warcraft. World of Warcraft, to be precise. I mean, it says Warcraft, it's actually World of Warcraft. That's a screenshot from World of Warcraft. So they started making money in Warcraft. So tokens in World of Warcraft are worth $20. So imagine this. Instead of actually saving up their own currency, they went in and bought stored value cards within World of Warcraft, each one of which was worth $20, because they knew that a couple of months from now, a year from now, their own country's currency will probably not recover, but the US dollar, equivalent stored value card in a game, in a MMORPG game, would be worth more. So currently the virtual currency in World of Warcraft is 7 times more valuable than the Bolivar currency, which is the currency of Venezuela. Imagine that. So World of Warcraft's gold is worth more than a country's currency. And that happened because people lost trust in it and hyperinflation happened. People spent money in a game. This means the people are always looking for a viable alternative to their own country's fiat currency. Anyways, so loss of trust that does not actually concern only weak economies or corrupt governments. I mean, a lot of people would think, oh, but it probably just happens to really crappy countries. Think about it. Argentina, Algeria, Venezuela, Zimbabwe. These aren't very strong economies, right? We'd be like, oh, but it probably doesn't happen with like strong economies. It's not possible. Not true. A global loss of trust within the Western societies has happened, and and the advent of new technologies and new technology system has actually accelerated this lack of trust. So if you look at it, if you look at the percentage who trust the government in Washington DC, always or most of the time, you'll see that people aren't really happy about it. Only 17% of American citizens trust their government to make the right decisions. This chart actually shows what's been happening. I mean, look at different presidents. Eisenhower, back then, people actually trusted him, and it was around like 70 or 75%, and it kept dropping. Kennedy, it rose to 80%, and then it started dropping with Lyndon Johnson, and dropped again, dropped further all the way down to 50% in Nixon's time. Then it kept on dropping, rising a little bit during C.W. Bush's time, and then rose a little bit in the earlier Bush's time, then C.W. Bush's time, then during Obama's time a little bit, and by Trump's time it's dropping. So now it's just 17, barely 17%. This is how much trust that they have, in their own society. So whether we consider information, finance, politics, people's trust has never been as low as it is today, even in the Western society, which is considered to be the most developed part of the world, right? So things aren't looking pretty. A loss of trust between nations has also happened, and that also causes problems. So in an attempt to increase political independency, the Russian government decided that they wanted to reduce its foreign reserve of US dollars and start stockpiling gold instead. So one will be like, okay, that's smart, right? The Russians like, okay, let's not depend on the dollars, because we don't like them, we don't want to be dependent on them. Let's start keeping more gold with us, so that so in other words, that government, the Russian government, also did something similar, like the Venezuelans, where they were saving up in World of Warcraft tokens. The Russian government decided that we should go back to the earlier system, and we should instead of saving up in US dollars, we should start saving up in gold, just in case. So they started doing that. So in 2013, in tons, the Russian purchase of gold in 2013 was around 80 tons, while in 2018 it was about 290 tons. Okay, so the percentage of US dollars in Russia's total foreign exchange holdings in 2017 was 46%, and now they have about 22%. So you notice that even governments are doing that. Governments are looking for alternative viable means in which to store their value, because they're not trusting the current system. They're not trusting the current fiat system. They are unhappy with it. So are we heading to some kind of end to the way of fiat money, or monies issued by central banks? So eventually it is possible. This is a quotation by Jim Reed, who probably is some big shot in the Deutsche Bank. So he says, eventually it is possible that inflation will become more and more embedded in our system, and our doubts will rise about the sustainability of fiat money. So according to his quotation, it's like there will come a time where we'll be like, you know what, the inflation is just enough is enough. and they'll be like, we no longer trust it because it's losing value. It's losing value all the time. We don't want to trust it anymore. Is this time already here? Not quite. But will it happen? Probably. So this is a nice little cartoon here, Um, this is how they're thinking about it. So the world's rolling. The cartoon just represents the world's rolling, and these people represent the central banks, the fiat system. So if things are slowing down, they just keep on plugging in more money. They're just creating more money. That's all they're doing, more money. So by just fueling it and keeping on more money, every time they create more money, there's inflation. So what was worth 10 years ago is worth 10 times less today, right? So that's inflation. It's going to continuously happen. There's hyperinflation that is bound to happen. So while not yet offering a complete alternative to the system, there are several low-tech projects, non-tech projects that have tried to solve this problem and give people an alternative way of having and saving and storing and exchanging value, distribution and storage, as well as issuance, which is emission. So distribution, emission, as well as usage of value. So they created an alternative money with restrained rules of use. One was local monies like USCO. They have emerged to restrain the use of money in a local area only. So think of it like a closed network that we talked about, kind of like a virtual currency or like a stored value card that's only usable in a certain set of companies or a certain set of retailers or a certain region or certain area. So with currently 1.5 million USCOs in active circulation in the Basque country, it is a way for the local communities to refocus on their real economy. So what is happening is that in Basque country, there are about 1.5 million USCOs and people are using this. So this is an alternative, money system, but it's limited. It's low tech, but it's limited. So a lot of people in the local community are using it in that country. So then there's another one, support the local convenience stores and artisans. What have they done? So in an effort to help local stores cope up with the COVID crisis, the community of Tours in France has launched an initiative where people actually buy vouchers worth 20, 50 or 100 euros, and they're valid until 2020, by the end of 2020, which is today. So since March 23rd, 2 million euros have been redistributed to about 7,000 plus local stores. So they've created a new stored value system because the euros are not available. So they have actually created a new mechanism through which people can, and that stored value can be used until the end of the year, was usable until the end of the year. Anyways, so this was another way. But these are both low-tech solutions that have a lower impact, a smaller impact, but they're trying to do it. So it's not like what we're about to talk about in cryptocurrency is something new. That's what I'm heading at. So at the most critical moment in recent financial history, which is when the financial crisis happened of 2007, 2008, this one fellow, this guy named Satoshi Nakamoto, which is a fake name, nobody knows who this person is, right? Or whether it's a group of people. This guy puts up a research paper, which is known as the founding paper, and calls it Bitcoin, a peer-to-peer electronic cash system. And this new electronic cash or digital cash system was supposed to be, sort of an alternative. So was it coincidental? Maybe. We don't know. Is there a conspiracy? Nobody knows, really, maybe. So in late 2008, when the world's entire financial institutions reached a peak of distrust and there was a lot of problems happening and the world's economy was crashing, a new idea was given. What if we replace the trust that we have in a government and therefore, subsequently their central banks, and instead replace it with a decentralized system and place our trust in a mathematical and a technological solution where everybody is involved, and it's, instead of having a centralized authority, it's decentralized. So while the system actually works, the current system actually works well enough for most transactions, there are some inherent weaknesses. There are a lot of weaknesses. The current fiat system does work. Yes, 2007, 2008 happened, things went on, the system's working, but there are issues with the way that we know the current system works. So this alternative was a possibility, but did that person come up with this alternative at that very moment in time on purpose? Was it as a coincidence? Was that person or that group of people planning it? We don't know. But was it a possible alternative? Yes, it was. It could have worked, and it probably can. Let's see. So the same concept that FaberNovel the company that's been making these cases that I've been, putting up the audio lectures for, has been saying that software is eating money. In other words, software is replacing money and is also gaining ground in this industry. How so? So a new technology with a game-changing potential that is very similar to how the World Wide Web changed the world for us. So in the 1990s, more specifically 1989, Tim Berners-Lee, the creator of the World Wide Web, created a new system. He allowed people to share data and content with even people who are hard to reach through the World Wide Web. And people across the globe were able to actually connect and share information. So, this is what he did. Tim Berners-Lee actually wrote a paper where he actually talked about the hypertext project, which became the World Wide Web. One of the quotations from that paper is, "The current incompatibilities of the platforms and tools make it impossible to access existing information through a common interface, leading to a waste of time, frustration, obsolete answers." What he was referring to was the internet. The internet had several different protocols and several different ways in which and interfaces that just did not work with each other, because the internet was created by several companies and the internet basically is a network of networks. So there was a lot of incompatibility. There were a lot of issues with sharing that information with everyone. That's what the World Wide Web solved by creating a commonly accessible platform that everybody was able to use. So by 2008, a major change is coming in again, this time in the financial industry. So instead of actually continuously trusting the central bank systems, the fiat money system, Bitcoin proposed that we gain independence from those institutes and create a new monetary system. And what did Satoshi Nakamoto say in his paper? He said, what is needed is an electronic payment system based on cryptographic proof instead of trust. So instead of you just trusting your government because, you know them, so you trust them, and then trusting the central bank that's been created by that government, you instead trust a mathematical system to, be worthy of trust, because, well, a mathematical system is infallible, right? I mean, there's nothing that you would doubt about that. So nobody knows who Satoshi Nakamoto is, but that's what he says. So the same way that the World Wide Web changed the way that we communicate and share information today is the same way that perhaps the blockchain and the Bitcoin system is supposed to change the way that we understand and use money and money systems. Bitcoin finds its roots in the long established scientific and economic research, that's been applied to a new field in pursuit of new objectives. The idea is, this isn't anything new. We're just taking something that already exists and applying it elsewhere. That's what creativity is. Creativity is not about coming up with something completely novel. What really happens in creativity is we connect hitherto unconnected ideas, unconnected concepts, unconnected systems, unconnected concepts, unconnected facets of life, and we come up with something new. Right? This is what happened with Bitcoin. Bitcoin is actually the birth of something that has happened because of bringing together two things: cryptography, which has been used since ancient history, since Julius Caesar, and even earlier, since the times of that the Jews were in power, and they've been used to hide information, to keep it secret, while at the same time a whole branch of how people think and make decisions that is part of economics, known as game theory, which is a form of applied mathematics. These two branches were brought together, and we have Bitcoin. So what is cryptography? It was driven by the need to send and receive secret messages so that nobody else had access to them, and it has existed for thousands of years, as I mentioned. And in the past few years, however, the need for it and the mechanisms have improved drastically. And the same thing was actually used to create the security system, the trust-based system that powers Bitcoin or all cryptocurrencies. On the other hand, game theory, which is based on applied mathematics, has been used. And Adam Smith, talked about it. John Nash, a major, important individual with respect to game theory. There's a whole equilibrium named after him about decision making called the Nash equilibrium. I would highly recommend that you go watch A Beautiful Mind to better understand John Nash and his contribution to economics and game theory. Anyways, so a new frameworks were designed to understand and predict how people will make decisions in any given scenario, why they would make those decisions. Anyways, By using this concept of game theory, and more specifically the idea that we need to approach for and understand why people will make certain decisions, what is their incentives, and how they would be willing to trust a system where they would focus on the common good, where there is no trust involved because you're not trusting a central authority but rather trusting the system, and where people would be willing to do that. So these two aspects, these two different fields, the game theory and cryptography fields, were brought together to finally create Bitcoin. So Bitcoin is not completely brand novel new idea. It's an idea that has been born because of the bringing together of these two different fields. One belongs to information sciences and computer sciences. The other is applied mathematics and economics. Anyways, so a series of trials have happened. A series of things, like everything that evolves, everything that's created, it's not created like just like that. There have been several attempts at creating something similar to what we have today in the form of cryptocurrencies. Now, cryptocurrency is the general term. Bitcoin is a proper noun because, and it's also used as a common noun with a small b. Bitcoin is the most popularly known cryptocurrency, while there are several other cryptocurrencies. Cryptocurrency is the name given to any new money system, any new currency system that is based on cryptography. So cryptocurrency projects aren't anything new. There have been attempts. In 1983, the first attempt of a cryptographic currency project, which was also briefly used in a US bank, was between 95 and 97. So it was used in 95 and 97, but it was actually created in 1983. Okay. So then later on in 1997, there was a new system called, hash cash, right? So cryptographic system to fight email spam, which laid the major foundations for the Bitcoin's mining process. The same hash cash system will eventually be used as part of the Bitcoin system. So it was actually created. It was a cryptographic system that was actually created to control and handle the spam, the junk mail that we receive on our emails. In 1998, B-Money and BitGold, which was a cryptographic currency proposal, which also tried to create the same kind of a system, which was a decentralized system, was suggested. In 2009, after Satoshi Nakamoto actually published his paper and people actually used it and created that system, 2009 Bitcoin was born. 2015 another new cryptocurrency which is very popular, which is specially used in smart contracts, Ethereum, was born. In 2020, or more specifically the beginning of 2020, Facebook actually launched its own cryptographic currency system called Libra, which is going through some troubles, but it will eventually come on top. They're working on it. They even launched it in Brazil. Anyways, that happened. And then the future. Again, there's a quote from Tim Berners-Lee, the co-founder of the World Wide Web. Okay, so what he's trying to say is that he didn't really do anything. All he did was, there was already stuff available. The TCP, the Transmission Control Protocol, the protocol actually that lets us send and receive packets over the internet, data packets. And the DNS, the domain naming system, which allows websites' IP addresses, their network addresses, to be converted into their website's URL. Well, and other protocols, various other TCP/IP protocols, the UDPs, the HTTP, all of those were already available. All this guy did was, he says, that he brought them all together. So most of the technology that was involved in the web, like the hypertext itself, the internet, the various text objects, the multiple fonts that it was able to handle, HTML, all of it was already there. It was already designed. All that he did was, he just had to bring them together and take them to a higher level of abstraction, create a new standard out of it, and ta-da, the World Wide Web was born. So he just took those ideas and brought them together. So it's not like cryptocurrency was born in 2009. No. See, the process has been going on for a long while, the same way that the World Wide Web did. They're just giving you an analogy to better understand that the World Wide Web was not just born in 1990 or 1989. The things that actually led to it were already there, and this person actually helped bring it together. This is true for any evolution, hence the term evolution, right? So what exactly is this? What facets are we looking at when we're talking about a new form of money that would finally eat up the current system, finally change it? So how is the software changing it? And as the term is, allowing software to eat money or change it. So one, it's programmable. A core property of cryptocurrencies is the programmability of their core functionalities to best fit the use case they aim to address. Use case is a term which actually means how it can be used or what purpose or what scenarios. So different scenarios it can be used in. So unlike fiat money, which is only used for transactions, you could actually use a cryptocurrency system for any purposes. You could store information in it, you could store contracts in it, you could use it to identify valuable possessions, intellectual property. There's so many ways in which it can be used. It's not just for as an exchange of value. It's not just meant to help you buy groceries. That's one possibility, but there are several others. It's the software helps it become decentralized. Unlike the current fiat currency system, which are centralized, digital cash or cryptocurrencies, as they're called, are decentralized. They are based on a peer-to-peer network that's controlled by people involved in that system. All the participants, everyone who has a cryptocurrency is part of that system and helps maintain it. So users are part of the system. And multiple agents secure it by verifying those transactions. So there's not one single authority that everyone trusts. It's not centralized like a central bank, hence the term centralized, right? It's decentralized. There's no one singular authority. Everyone's authority, and everybody together as a consensus agrees to trust it, agrees to control it, issue it. It's transparent, unlike the fiat system, where the information between a bank and a customer is just between them. Here, every transaction is recorded on the blockchain. Again, as I said, you need to know about bitcoins and blockchains beforehand to better understand this case. Anyway, so refer to the audio lecture for that, or the case studies, or the several other YouTube lectures available by other people. So all transactions are recorded on a blockchain and they're made part of a public ledger. Hence, everybody has access to it. Everybody knows what transactions have happened. This does not mean that their identities are revealed. This just means that the details of the transactions are kept by everybody. It is direct. Users have complete control over their assets, unlike the regular system where the banks actually own the money. They keep the money where you can take it and use it. Here people control it. It's in their possession. They have it. So banks and governments cannot, seize it. They cannot be frozen. They cannot be taken from people. People possess it. Like a piece of gold that you hold in your hand, it's yours. You don't keep it somewhere else and then issue a piece of paper that represents it, and you can only have that piece of gold when the bank lets you. That's not true. Here, you hold the value. It's yours. So you have direct control over it. So this software eating money leads to enabling of a new form of money creation and distribution and use. Money creation is emission, distribution, and then usage. We talked about the three functions. So asset inception, how does it get created? So again, I would ask you to go refer to the entire lecture dedicated to Bitcoin and blockchains to better understand this, but I'll still briefly talk about it. So in the white paper about Bitcoin, Satoshi Nakamoto, the creator of Bitcoin, actually said that the parameters of this coin and the features of this network are the blockchain. Okay. And the other specifications include the rules of how it's created, how it's minted, the amount that is going to be issued. He even specified that, the issuance rate, the accessibility, how the exchanges will happen, how the transactions technicalities will happen, where will this asset be stored. He talked about all of this. Okay, how will the safety be maintained, everything. He or she or whatever group of people that represents Satoshi Nakamoto actually talked about it. The network is mentioned in 2009. It's actually created in 2009, and the distribution starts. It's actually bootstrapped. It started in 2009. It becomes, gains, interest from people. People get involved in it. More coins are distributed. Broader, audiences get added to it. People first find it interesting, intriguing. They start using it, and they're like, this works. So they start using it. A lot of growth happens. People start using it. Network effect, right? More users start exchanging it. More people start trading coins. More people become miners. Hence, more bitcoins are created. There are more transactions in the block. Miners continue to contribute computational power. More coins are minted, and so on and so forth. Metcalfe's law, network effect. Boom! There's a lot of scalability. Eventually, the total amount of bitcoins will reach the maximum supply, which Satoshi Nakamoto already talked about, which was going to be 21 million precisely. And that will happen somewhere around 2140. And then no new bitcoins will be created. Users can still use the network to transact, and a new block will keep on being added, but there will be no new bitcoins, hence no new inflation. So now they will continue to revolve, continue to be distributed, continue to move within the economy, and they will be used. That means that this system is scalable and it's resilient because it stops, or it rather, resists inflation, any kind of inflation. So software eating money means that there's going to be a major change in the entire system. It's going to lead to a complete paradigm shift from these, five things to these new five things. Let's cover them one by one. So let us look at all of these paradigm shifts from the earlier system to the new system one by one. The first one, from the earlier system that was regulated by the state, by the government, which created the money and marketed that money, to a new system that will be more of a distributed control system that is distributed among its participants. So what we're essentially expecting is to happen is that we're leaving this era of guarantee that was given by a central, authority, that was given by a public institute's goal that it would guarantee the stability of currency, the relevance of interest rates and security of a citizen's deposits, to a new system that is all about transparency. There are rules dictating the currency's creation, as we talked about it, its distribution and its use, and those are openly published and openly available. They're technologically enforced because of the very design of that system. All the records of all the exchanges are kept accessible and are maintained by everybody. And it is a network that is powered by transaction approvals. If you know about Bitcoin, you know what we're referring to here. Then, earlier on, or in the current fiat system, it was a swapping, a costly trust and guarantee system. This public control and monitoring of the system has led to several problems. There's hyperinflation and there's a persistent stagflation, stagnation inflation. To a new system, which without proper battle testing of the founding parameters, we can't really say that it's going to change completely and become better, but we can say that it will eventually probably be better. We're going to test that because the current system has apparently failed. We can see that. Moving on. From a control over agents allowed to transact and own currency, who actually own currency on our behalf, the private banks, they would control our currency. They would decide where to transact it and how, to a new system which is open and accessible to everybody that owns it. So how do we do this? We're going to abandon the current controlled economic boosting, which is endorsed by private banks, where they direct unused capital and they decide where to invest it. Whenever we basically deposit our money in the banks decide where they invest it. They invest it on our behalf and sometimes on their own, and then get some returns on it. To a new system which is going to favor democratizing this access to the economy, where while we're still being limited in access in part due to the technological requirements, there is no single institute, no single organization that will control this currency, that will control its creation or distribution or ownership, and it will make it impossible to stop anyone from using it for any purpose. It is basically their decision. It is going to be the decision of us holders of that value, keepers of that value, maintainers of that value, owners of that value, to purchase it, to sell it, to store it, or to invest it. From the earlier system, where it was solving the unequal distribution of capital problem, which is the biggest problem, right? So the private interest may negatively impact this entire thing, right? Because they have their own interests. So they are, it negatively impacts the proper distribution of that capital because it's handled by a bank, or because they are blocking some access to the economy because of conditions, lending conditions, because of excessive distribution risks, and lots of other problems. On the other hand, there is no distribution at all. It's open to all without any financial institutes acting as players in the industry deciding where to use them. Unused Bitcoin such as left on digital wallets and are unproductive. And when they become unproductive, well, it's useless, right? So there is no distribution involved. That Bitcoin that you just keep and store and don't use becomes useless until you use it. So it will encourage usage automatically instead of actually having to convince people to do it. So In the other earlier, in the current era, the fiat money era, there is a lot of blockage because they don't know where to invest and whether they even have the option. Now they have the decision. They can decide whether they want to invest somewhere or not at all. So it's comparable to just, well, storing gold bars under a mattress. Analogous to the same thing. You can keep bitcoins in a wallet and then store it in a USB and just keep it away. Use it on some rainy day, or invest it if you like. So from heavily intermediated exchanges, in the case of the current fiat money system, to a new global network of peer-to-peer transactions. So in the current system, there's lots of private banks, there's central banks, there's lots of parties involved. Now, the new system, the Bitcoin system, will not have that. So dropping the protection of financial intermediaries, which were acting as intermediaries between two parties during transactions, during financial institutions, they can become legal protectors, right? When somebody invests some money, a bank is involved in between. They're playing the part of a mediator or an intermediary, to a new system that interconnects this unique shared ecosystem. It leverages the unique value of Bitcoin because it's a decentralized system. There are no intermediaries. It's disintermediated. There is no intermediary in any transaction between two people or two economic agents or two individuals or two entities that want to interact using the Bitcoin system. They want to send, receive money or invest money or do whatever they want. The records are kept on the blockchain. Otherwise, there's no intermediary involved. From tackling the restraints of freedom of exchanges, there's a lot of heavy financial intimidation that is happening, and they're taking, they take their money, right? There's a lot of restraint on what you can invest in, where you can invest in, what you can get, what you can buy, because of geographical boundaries, because of political reasons, for whatever reasons. You can't get everything you want. You can't access those opportunities. For instance, you can't just go and buy some shares in some American, public company. You incorporate in some other country. You just can't, because obviously there are restrictions. On the other hand, though there'll always be need to validate whether a particular transaction can happen. That's what happens in a Bitcoin transaction. There is a proof of, proof of work that validates a particular transaction, but there is no such requirement. So there's a potential crunch of validation capacity, which will, of course, continue to happen. There will be a check and balance, but at least there's freedom because you can make any transaction within that system. From delegated ownership of money, because we would delegate the usage of our money, the central banks would give it to the private banks. The private banks would then take the responsibility on behalf of investors, us or depositors, to a new system where the complete ownership of our monetary assets is with us. So leaving the centralized stores of value with complete visibility over held currency assets, private banks have been helping fight the informal economy, and they're monitoring illegal activity, and they eventually have almost complete access over their customers' money. They have access to it. They know who has how much money, to becoming our own bank now. With all the cryptocurrencies, we hold them ourselves. We hold them in a anonymized, a pseudo-anonymized, because of course it relates to us, but nobody can identify who we are. Digital wallet, we can't be restrained. It's ours. We are our own bank, and we are responsible for our own compliance to the rules, and the monitoring can still happen, and the governments can still monitor it to fight the illegal activities while we still own the money. So replacing the risk associated with others' mistakes, because say for instance the financial crisis of 2007-2008, it was the mistake of the private banks and the investment banks in trusting subprime loans, and that's why that disaster happened. I already referred you to go and watch Inside Job, which is a documentary, to understand it better, which was, which happened because we delegated the ownership of those investments to those banks, and they made bad decisions, and the assets vanished because they lost a lot of money. The entire world lost a lot of money. Greece, Iceland, they nearly became, bankrupt. On to the risk being associated with our own mistakes. Since there are no external actors involved, nobody's going to affect it. It is our own responsibility. We decide where we invest. So there's no chance of recovering them if you lose them. So many users have lost fortunes. Around 4 million bitcoins is estimated to be lost forever because people have lost the USBs that contain the bitcoins, or their records, or the hard disks that contain those records have been lost. So there's no private or public institution that you can turn to for help. Yes, that may be a bad thing, but on the other hand, it's a good thing. Now we are responsible for our own actions. From a volatile trust with limited options, because the trust that we had in fiat money and the issuers of those money, which are the financial institutes and their governments, is vanishing. this volatile. It's been decreasing. So it's an immoral capitalism, or between the hands of immoral people. It's the nature of the fiat money that allows its weaponization, economic decision. I mean, entire countries, entire communities can be destroyed based on the decisions made by the central bank. It's done on purpose too sometimes. To a new system which has trust embedded into it because of its technology, by its design, on purpose. It's there. It's a strict application of rules that is guaranteed because of its very nature. So it's based on cryptography and game theory, like we talked earlier. Cryptocurrency leverages the technology to make it secure, and it enforces, it embeds, it integrates the rules within the protocol, within the system, so that nobody can misuse it. So economic agents are more incentivized to act in a manner not to harm others. I mean, the only way that a miner can make money is by doing it in the right way. So it helps everyone because that's how they're going to act. So unlike the earlier or the current system, which actually, facilitates corruption because people are looking out for their own benefit rather than the benefit of the whole. The new system, the Bitcoin system, facilitates or incentivizes people to take a decision that is helpful for the entire community instead of just one individual. So from escaping an optionless system, there is trust, but there are few viable options where they could shift, and there was a lot of barrier to entry to a new system that is to enter into a new exclusive reliance on technology, which is completely validated, where you simply cannot exist, where you cannot be part of it, unless you actually trusted the system based on its technology, not the trust that you held on those people, but rather on the people and the technology that runs it. So you don't need to trust the system, you need to trust the technology that powers the system. You don't need to trust the people, you need to trust the technology that powers it, and the technology is based on mathematics and cryptography, right? So there's no need to trust an individual or a central authority. So years later, one would assume, since 2008 and 9 onwards, that Bitcoin would become a replacement to fiat money and it would become well accepted. Unfortunately, that's not happened. Bitcoin founders never intended it to replace fiat money. This is something that I've always said. This is not what it was made for. It was never meant to replace fiat money and to change the world, but it wanted to experiment with a new alternative monetary system. Maybe this will work out. Maybe it will evolve into something even better. Maybe there will be a form of a hybrid, a sort of a synchronization of both, and something new might be born out of it. So while Bitcoin is now considered by its growing community of users to be very resilient in its manner of storing value, and it's very powerful, it's a very, very reliable system, it is still showing difficulties for showing a lot of problems, which is causing a lot of people who have always criticized it from accepting it. So number of transactions registered by the network increases at a slower rate as new people get added to it. So the larger the network becomes, the slower its ability to handle more transactions. This is because of the nature of the blockchain. The more transactions that get added to it, the harder it becomes to verify them, and hence it becomes slower. So as newcomers get added to the system, Bitcoin becomes more difficult. So Bitcoin as an asset is still massively used as a speculative tool. So it's still something that people are interested because of this problem. So Bitcoin has not yet managed to become electronic cash as it was intended to be by Satoshi Nakamoto. So value Bitcoin to and from online payments. If you look at it from 2015 to 2019 and 20, it's constantly changing. It rises and it falls. So there's a blurry legal framework that's slowing down this wide acceptance because the laws aren't clear. Okay, businesses don't understand how to handle it. A currency democratization depends on its ability to be accepted as a widely accepted means of exchange, which apparently hasn't happened. Some countries accept it, others don't. Some central banks are okay with it, others aren't. So if it wants to be accepted widely, there needs to be a legal framework in place by all the countries, all the sovereign nations, for it to be accepted. A reliance on technology is hurting accessibility. So a lot of people get confused by it. They don't understand it. Bitcoin is scarce, and it's supposed to be, in addition to the fact that it is also technologically quite complex. So getting a Bitcoin requires some technological understanding and even technological access. In order to create a Bitcoin, you need to have a computing device. To even have a Bitcoin wallet, you need to have a computing device, at least a smartphone. And that's still something beyond the power of around 2 billion plus people, because they don't even have that, let alone a proper desktop or a laptop or any other computing device. So that's also a problem. People don't have the technology to own a Bitcoin. I mean, where would they store it? You need to have a computing device. Where would you mine it? You need to have a computing device even for that. So even to participate into it, you need to have a technological device, and 2 billion people still don't have that. True enough, a lot of people don't even have access to fiat money, but still, comparatively, the numbers don't look that great for Bitcoin. It's a resource-intensive, mechanism. The system requires a lot of electricity to mine new coins, and that limits its scalability. You need to have a lot of energy for the cryptocurrency protocols to keep on working, and there's a huge environmental impact because you need more electricity to run the computers that will be used to mine, whether they're GPUs or CPUs or whatever other device, but they will require a lot of electricity. That electricity comes at the price of the environment. So the computational power required is currently unscalable. We are going to reach a roof. We're going to reach a point where it will be very hard for any miners to mine new cryptocurrencies, new crypto, currency, Bitcoins or Ethereum or whatever, because they don't have enough electricity and they don't have enough energy. They don't have enough computational power. We're going to hit a roof at a point, and that limits its scalability. So has Bitcoin made a mistake? Has there been a problem, which is why this is happening? So 12 years even after that research paper was published, if you count from 2008 to 2020, Bitcoin is not still even close to global adoption. It is far from reaching the expectations of what the visionary adopters wanted, what the people in the very beginning who started using it wanted to happen. And a lot of detractors actually say that it's a trapdoor for cash. It's a speculative system, and it's just another tool that people use for illegal activities, for dark web activities, for under the table deals, and it's just a dirty system. So Bitcoin has inspired several cryptocurrencies. For instance, there's Monero, which is usually used for illegal activities such as ransomware attacks and payments fraud, ransomware, and money laundering, and the target killings and whatnot, and assassinations, hits, you name it. Every prostitution, pornographic rings, it's used in various places. So people who criticize Bitcoins are obviously going to point at things like Monero, a cryptocurrency that's been used for nothing but bad stuff. Anyways, so it's used to finance illegal activities, has reached a huge height by 2019, right? So the dark net market, the dark web as it's called, which is basically the internet that it cannot be accessed normally, which is usually used for several illegal activities. The value of the Bitcoin has reached quite a bit there, because people use it for illegal activity because it's untraceable. Right? So public and private actors have started to leverage the technology to serve diametrically opposed objectives versus what people wanted to do. So a lot of people, governments as well as individuals, have been starting to use Bitcoins and similar cryptocurrencies for things that the people who created it didn't want it to be used for. So the People's Republic of China in 2014 created the Crypto Yuan project, which was trying to create a state-backed cryptocurrency. Okay, it was reintroducing a two-tier system with commercial banks and distribution intermediaries. So there would be banks, there would be commercial banks, and there will be distributors who would then use this cryptocurrency, and they could then still get more control on individuals and restrain their freedom even more. So they were using the cryptocurrency system only with the same two layers. Instead of central banks, there would be commercial banks and a whole layer of distribution intermediaries, various intermediaries, exchanges and stuff. So it would defeat the entire purpose. Another such project was, as I mentioned earlier, was by Facebook in the mid of 2019 called Libra, where they said they're going to launch their own cryptocurrency. But there was a lot of doubt because there's a lot of effect on user privacy. People have already gone through the disasters of Cambridge Analytica, a scandal that Facebook had to face, because of the Trump election and everything. So a lot of issues have happened with that, and there's a lot of issue about whether it's okay for a company to own it, for a company to own a whole cryptocurrency system, because that defeats the purpose again. That becomes a central authority. So there's a privatization of access to currency. That means that the currency would be issued by and handled by and controlled by a private organization or one single organization, which again forces people to to make decisions based on their connection with the government. So if Facebook announces its cryptocurrency, which is Libra, and they have to abide by certain government rules, they will bend the protocols, they will change the system of their cryptocurrency to suit that, which again defeats the purpose of freedom of where you want to invest as a customer, as a user of that cryptocurrency. So let's look at another thought, okay, which Tim Berners-Lee says, same thing as the World Wide Web. So at pivotal moments, he says, at pivotal moments, generations before us have stepped up to work together for a better future. With the Universal Declaration of Human Rights, a diverse group of people have been able to agree on essential principles. The Universal Declaration of Human Rights is the charter written down by the United Nations, right? So with the Law of Sea and the Outer Space Treaty, we have preserved new frontiers for the common good. So we've worked on that, haven't we? As the human race, we have decided that space is going to be used by everybody. Okay, it's going to be for the common good. The same thing has happened with regards to the laws created for maritime movement and sea, right? So now too, as the web reshapes our world, we have a responsibility to make sure it is recognized as a human right and built for public good. That's what Tim Berners-Lee said at a web summit in Lisbon, and where he was talking about talking about the contract for the web. So he was basically talking about how the World Wide Web is something that we created for the common good, for everybody's good, not for one company or one organization or a set of individuals or a handful or a group of people, but for everybody. Now we need to think in the same mindset. We need to think in the same way and try and achieve that same goal with cryptocurrencies, with Bitcoin. Maybe not this current form, maybe change it even further, but we need to think as a whole, as a species, as a group of people, as a race, rather than just as individuals or groups or private organizations or banks or sovereign nations. So the question is, are we going to seize the potential of technology to build a better future, or are we going to stand still and watch it being diverted from its greater potential? So we have this really good opportunity, we have this really good system, we can build a better future using this technology, have a more inclusive financial system that will bring along everyone on board eventually, or we could just sit here and let this system be overtaken by these individuals who are looking to have their own benefit out of it, whether it be illegal activities like Monero, whether it be state control like the People's Republic of China's crypto yuan, or whether it be something like Libra by Facebook, where Facebook wants to use it to have stronger controls over their own users. So let's take another quotation by someone really, really influential throughout, our recent times, Noam Chomsky. He says, technology is neutral. It's kind of like a hammer. So the hammer doesn't care whether you use it to build a house or whether a torturer uses it to crash somebody's skull. So is Bitcoin technology evil? When people say that it's used for illegal purposes, that's exactly what you say. It's like a knife. You decide to cut an apple in half with it or slit someone's throat. That's up to you. So the Bitcoin technology isn't bad. It's the usage. It's the way that it's being implemented, the way that's being used that could be questionable. And that's something that we as users, as individuals, as people who are part of that system, or who can be part of that system, or who have access to technology that can be part of that system, have to decide. So let's get to the second part, which is cryptocurrencies as an answer to our system's inherent inefficiencies. So cryptocurrencies are going to try and solve the problems of our current system. So since the time that Bitcoin happened, new currencies have started to emerge, and they have a wide area of use cases. They've been used in various different ways, and they're making a lot of new solutions happen. For instance, Bitcoin, which was the first cryptocurrency, the idea was there will be no institutions, there will be no central authority, people will have full ownership of their amounts, there will be traceability, there will be programmability, the same system can be used in different environments, etc., right? Then Ethereum came along, which talked about a smart contract platform where you could make different contracts, property contracts, property transfer contracts, various, trade contracts that would be recorded on a public ledger, that would be recorded so that there is transparency. So the contract was included in the transaction. There were conditions of its use that were defined. There were intangible assets or impacts that became valuable. Intellectual property rights, whatnot, could be handled by it. Then there were a whole, set of new cryptocurrencies. There's Algorand, there's Labs, AVA Labs, there's T3, there's Cosmos, there's the Definity and Celo. So there were third generation blockchains. The focus now was on scalability so that the system could grow faster. It would be easier to use. So cryptocurrencies frameworks were made more accessible. Now anybody could create their own cryptocurrency. The technical improvements have caused it to have better scalability over the years now. Now it's more scalable, it requires less computational power. There's more interoperability of different frameworks so that new systems can be created by a combination of these cryptocurrencies and their frameworks. And now we're moving towards a Web 3.0, which is money systems generated by people. No tech projects that could be taken one step forward if they use software. So we talked about two tech projects. If they were to use these technologies, they could get even better. So the Automatic Boost to Communities Act was proposed by Congress in April 2020. This project that the American government actually created was aimed to provide each American, especially those left out of current relief checks, with a $2,000 aid distributed through prepaid cards. So these are like stored value cards that they could use elsewhere. So this bill aims to lay the groundwork for a permanent treasury administered digital public currency wallet system. So they're creating a new stored value card system that people can use to buy stuff, especially because of the current crisis. That's when they created this. So there's an opportunity of cryptocurrencies in this project. How so? Yes, these cards will be useful. Yes, they are useful. But how would cryptocurrencies or a Bitcoin-like system help them? It can help create an anti-inflation effect. By minting a new currency instead of printing trillions of dollars, will avoid the risk of inflation while ensuring economic runoff. So there'll be no need to create new currency. Instead of printing trillions of dollars, which would risk inflation, they could actually have a Bitcoin-based system instead. They can define the conditions of distribution and use so that they can decide how the local communities will use it. So using a Bitcoin-based system with this will help you with this, right? Then there'll be the software effect. Money creation and distribution will be at no cost at all. Instead of having to print these cards and create them and verify them and validate them and then distribute them, that can be done through a software, through a Bitcoin-like system. There'll be complete traceability should a system like the digital dollar, as the US bill is trying to create, would be using a blockchain or a Bitcoin-like system or a cryptocurrency system. It'll be traceable because every transaction will be traceable, and it'll be regulated, and because that will be part of that system. They can decide on the rules. There will be more divisibility and convertibility and easier acceptance. Why? Because you can have any denomination possible for that cryptocurrency. You can easily get it converted from one system to another, because Bitcoin would be acceptable into another system or a similar system. So this would allow it to be accessible easily by anyone for whatever purposes. There's no restriction. It's like an open source software, analogous to that, similar to that, because it allows you to be used for whatever purpose. So beyond crypto dedicated firms, a very diverse range of players have already started working on cryptocurrencies and looking at them, so that they can leverage and develop its features for their own purposes. For instance, other areas. I mean, other than banks and other than businesses, there are several other groups who've started to look at cryptocurrencies as a possible solution to their problems. For instance, the community, ruling in Liman's local currency, relied on cryptocurrency features to deploy currency in a digital world. Okay, so the Liman local currency, right? They started using it. Firms such as Ubisoft, which is a giant gaming publisher as well as a developer, they decided to partner with a blockchain firm called Ultra to start thinking about creating game-based cryptocurrencies or gaming tokenization. So they could create in-game currencies that use cryptographic solutions, or more specifically blockchains. Several NGOs such as the Charity Water Organization have started to organizing the development of clean water coin to facilitate water access project funding. So they've started to use it in the NGO circles. Public institutions have started to do it. The French Central Bank has started to think about crypto features for creating a new digital form of the euro, or to create an alternative, to the euro, which will be a digitally, supported one. Now, one would think this is very similar to the, the crypto yuan. Yes, but if they were to do it in a more open and inclusive manner, if they are not as restrictive as the Chinese government, then maybe this can work. They can think about it. It could be an alternative. This would then allow, in theory, to solve the biggest challenges that humanity has faced, which is the dilemma of economic arbitration in the pharmaceutical world, in the healthcare industry. So, pharmaceutical company is the producer of medicines, right? We know that. They're the sole producers of medicine that are supposed to cure a rare disease, right? Now, the improvement of the health conditions in Western countries has reduced the market, and that has caused a rise in production costs, leading to production shutdowns. Weird, isn't it? Think about it. Pharmacies create new medicines. When healthcare has gotten better, no new medicines are required because health conditions are getting better. When the health conditions are getting better, less money is invested in pharmaceutical companies. Hence, they don't have enough money to create new medicines and to produce new medicines for countries that are less privileged who want to buy those medicines. So there's no investment in them. Remember, we talked about the clusters. So the healthcare cluster is not getting enough money. So how does crypto solve it? Crowdfunded. Because cryptocurrencies are crowdfunded. They are supported by people. So the company, instead of actually asking money from people, from investors, they will then estimate how much money it would require to produce the medicine. Tokens or digital cash would be created by the company. People will acquire them. And every time a tablet is produced, a medicine is produced, the company will receive a part of that token from people and create those tablets. So they could do several things with it. Basically, the pharmaceutical company would create its own cryptocurrency to handle the investments from people that would then power them to create more medicines instead of relying on a fiat money. And this will be done by people who actually need that medicine. There we go. Solve the problem. So if we fail to change the world at once, why don't we try to correct its malfunctions one step at a time at all levels? True enough, right? So don't expect the Bitcoin system to just come in one fine day, swoop in and solve all the problems. Yes, it will take its time, but we can do it. If we do it step by step, it will start solving the problems. So in practice, a lot of people, a lot of institutes, a lot of groups have already started the use of cryptocurrencies to solve specific problems. So there are 6 specific problems that the case highlights here, which is fighting local hyperinflation, funding developing real economies, accessibility to health services, rewarding online content creation, which is Web 2.0 creation, controlling private data use, privacy of data, and creating viable economic models for artistic creations, intellectual property. So let's look at each one. So how does the cryptocurrencies or similar systems like the cryptocurrencies fight local hyperinflation? So the fighting of vicious circles of hyperinflation and reboost in local economy has been done by a cryptocurrency system called Cello. So benefits of cryptocurrency in this project, what have they done? It provides local populations who don't even have a bank account, who do not have access to banks, with a stable way to store, send and use currency in which they can trust. So it has about 400 verified users. It talks about 6 events, 44 production verifiers. Cello merchants who are on board are 3. There's users and merchant interviews. Cello dollars were transacted. So they did an event. The screenshot actually represents this event where they actually created the money and it happened. So it boosts a local and closed economy. So in other words, it's a system that uses cryptocurrency in a small community for a small group of people, but it encourages them to start working with their currency and multiply its impact by using it. So the more people get on board on it, they can use it. The inflation rate, this was used in Argentina, by the way. So the inflation rate in Argentina in 2019 was 53.8%, right? And it highlights the kind of situation of hyperinflation that is going to be disastrous for the country. It already is. So citizens are struggling. This is why something like Cello, which was a cryptocurrency, solved it. So Cello, whose motto was making money beautiful or make money beautiful, the Cello Foundation was trying to solve this system. This is the current Argentinian fiat currency systems problems. And what did was they created a cryptocurrency called Cello stablecoin. They leveraged the higher connectivity of Argentinians. They have internet connectivity. The Cello stablecoin test project created a new currency for 500 locals using a digital smartphone, digital wallet on a smartphone, and they were able to do this. So around 400 to 500 people used it, and they had like 3 shops and they started using it amongst them. So it was a closed network cryptocurrency. It worked and it solved their problem. So people started storing more money, more of their value into this new system instead of the Argentinian currency because it had a very high inflation rate. Number 2, funding developing real economies. So tackling the failure of institutions to feel real problems. Now, every time we run into a problem like we don't have enough money because we don't have money to give to the healthcare system. That's usually the one that suffers the most. Healthcare, education, right? So how do we do that? How do we solve it? So the benefits of using cryptocurrency in the system: by limiting the use and convertibility of cryptocurrencies to create a snowball effect in local economies, and by fueling development of community services not properly provided by institutions. So we create a new cryptocurrency system that can only be used in a certain environment. You can only use it for certain purposes, so that the local economies will then use that money that is generated through those cryptocurrencies into the healthcare system. By tracking aid and economic tracking of aid economic repercussions in real time, to see whether the money that is being invested into the healthcare is actually helping. Why? Because $2.6 trillion is the lack of investment in various healthcare facilities in developing economies as computed by the World Bank. So beyond highlighting the need for additional financial aid, there is an urgency for the increased impact of this aid getting to the right people. So $2.6 trillion aren't getting in the hands of the right people in the healthcare industries in developing nations. Who did it? The Red Cross did. By distributing $1 billion every year through vouchers that were tracked by this cryptocurrency. By vouchers in regions affected by disasters, the Red Cross actually identified an opportunity to use cryptography so that they can track it, and this money gets to those people. Now it's traceable, it's transparent, and it also gets to those people. They created crypto credits. Cash aid is distributed in the form of crypto credits in mobile wallets that can be used within the local economy for everyday purchases, or even for community credit programs. People can use it to purchase their things for their health needs. The project aims to reach around 320,000 users by 2021 in 5 countries. So it's more traceable. The money gets to the people. They have it accessible on their mobile phones or even through community credit programs. For people within those communities who do not have mobile phones, they can get another physical form issued in response to those crypto credits, which can be used. So it's unlike US dollars or rupees or whatever local currency they would use, which wouldn't have been traceable. Accessibility to health services. So facilitate access to medical care by better remunerating consumer data. How so? Benefits of using cryptocurrency in this: it fueling a virtuous circle of data remuneration, leading to increased access to medical care for populations. How did we do it? 25% of Americans that have delayed their medical treatment for a serious illness are because they do not have the money to afford that. So they're delaying their very important medical processes, procedures, because they don't have the money for it, because people don't have access to the healthcare. So who used this method? The HIT Foundation. An expert in the field of healthcare customer data, the HIT Foundation identified an opportunity to reunite the unmet offer and demand. Users want to offer their health data, right, to health professionals, who in return would give them proper information. So what did they do? The HIT, a user participating in one of the available user research and health data collection campaign, will receive HIT tokens from the monetization of one's medical data. So what people are going to do is people are going to give away their information, their health information, as part of the research projects, various research studies, and in return, the HIT Foundation would give them these cryptocurrencies in the form that can be used in a healthcare institution to pay for their bills. So they're basically selling their information, their health information, which is going to be which is not going to be misused. It's going to be used for their own research purposes, and in return, these people will get credit in the form of a cryptocurrency that can be redeemed and used in another hospital. So they can pay for their health care and for their medical bills using the tokens or cryptocurrency given to them by the HIT Foundation. So they can go to a hospital, use the cryptocurrency that they gained by selling their information as part of the research, and there they go. Their problem solved. The HIT Foundation's problem solved. Then rewarding online content creation. Now, whenever we answer someone's question online, we're helping someone out, we're putting in some effort, we're putting up a YouTube video, I'm putting up an audio lectures, multiple audio lectures, trying to help out people, right? And I take help from a lot of people. This current case study was written by FaberNovel to teach people about it. What do they get in return? Nothing much, nothing really. I mean, yeah, they can obviously get money off of ads. That's one way. So there can be a use of cryptocurrencies to regulate online ads and to decide to use it as a way to pay back, to remunerate, to pay back the content creators. So advertisers buy ads, users are rewarded with tokens instead of dollars, and users redeem those tokens or reward creators for it. So this is how they work. Benefits of a cryptocurrency in this project would be that put back creators at the core of the online ecosystem while allowing them to reap benefits of their content uploads. So every time somebody makes something and puts it online, they are paid in cryptocurrency. Tokens in this case are called BAT, an ERC20 token based on Ethereum. It uses the Ethereum blockchain, to actually create a kind of a cryptocurrency or a token called a BAT, right? So they're paid in that. So nurturing a saner web economy where the cost of quality content creation is financed more transparently by advertisers in search of audience. And why would the advertisers do this? Why would the advertisers buy those ads? I mean, they're buying those ads because users will look at those ads and they will get paid in tokens, and those users will then pay in tokens to the content creators to watch their content. Makes sense, right? So why? 45-55, which that is the split of ad generated revenues between YouTube and a content creator. So the content creator gets 55% while 45% goes to YouTube, right? So that's pretty sizable. So people are interested in making more content because YouTube will pay them about 55% that it earns from the ads. So who are working on this? An organization called Brave. Brave, through its new browser and associated token called BAT, aims to create a more secure and private internet where users can choose to see ads and receive value for their exposure to it. So users are going to be shown ads, they will watch those ads that advertisers are giving to them, and in return they will get paid in tokens, in BAT tokens, basic attention token, hence full form BAT, the basic attention tokens, and then these users can then pay in BATs to people who are uploading stuff, creating stuff, new content as a payment. It was launched in 2016 with around 11 million monthly active users, and by the end of 2019, BAT or basic attention tokens, which run on an Ethereum blockchain, are earned when a user sees paid advertising and can then be spent to reward and incentivize content creators to keep on making stuff. There, problem solved. It can be used to control private data usage. So you can take personal data ownership back and regulate its use through money incentives. How so? An owner decides that there is a verifiable claim, someone verifies it, and the verifier pays the owner, right? So how does that work? Let's see. Who does it? Sovereign identity for all. And how do they do it? How do they use cryptocurrency in this project? So give back control to users of the data, use and control its access and sale to selected service providers. So it allows individuals, in a similar way that the HIT Foundation was doing it for medical, information. Now a user can decide who they want to give away their personal information or data about them to, and in return get paid. So Sovereign will verify that whoever they're giving their, data to is reliable. So why? 3000 is the number of personal data attributes major tech players may hold and monetize, leaving consumers struggling to control these flows and benefit from the data's use. So if somebody is using information about me, and that somebody might be Google, that might be Facebook, and several other advertising networks, they have access to my information. They use that information to allow advertisers to target ads on me. So information about me is being allowed to be used by these tech companies to make money. So this company, Sovereign, says, why not you make money off of it, which is the user. So who? Sovereign. Within the broader project of blockchain-based SSI or self-sovereign identity, the Sovereign Foundation aims to give them back some power so that they can control it. So now we can decide. Sovereign tokens are there to act as means of exchange to monetize users' data. Either outgoing, if they wish to purchase identity attributes of data or data about themselves from issuers, or incoming from verifiers acquiring it. So somebody wants information about me, then Sovereign will pay me in these tokens. Or if I want to buy back my information or information about me or about somebody else, then I'll have to pay in sovereign tokens. Again, use of cryptocurrency to control data about us. Repairing a failing digital art financing exchanging model. So, see, with physical art, it was easy. There's only one of a kind of a painting. There are copies, yes, but there's only one of a kind of a painting. But what happens when there's digital art? Because copies can be easily made. Digitalization has made it possible. So benefits of cryptocurrency in this project. You protect and encourage digital art creation by rendering the ownership of a digital piece of art safe from copies and from frauds. So because the copies are possible, for piracy is very easy. So cryptocurrency can actually help, or cryptocurrency systems can help with this. It boosts the secondary market for art while still keeping the artist in the loop. They still get benefits out of it. So why do we do it? 64% of professional photographers had their work stolen over 200 times in 2016 alone. This is because digital art can easily be stolen by people across the world. It happens all the time. So who? There's a company called Super Rare. It was founded in 2017. Super Rare aims at finally mixing social connection and art collection to provide a new system for digital art. How did they do it? They created something called a unique token. Each creation and upload of a new piece of digital art on the platform is accompanied by its tokenization. That is the creation of an Ethereum token unique to the art piece. So they record the information about the creation of that art piece and its owner and information about it into the Ethereum blockchain. And this way, whenever it's being sold, there's a record of who it is being sold or resold to. That way, no new copies can be created that are not verified. So that's another, application of a new kind of a cryptocurrency to solve a new kind of a problem. So we've looked at all six different ways in which it was, helping different problems to be solved. Part number 3. Looking ahead, how can cryptocurrency opportunities be imagined and assessed? So how can we decide whether the opportunities can be thought up of and whether they are viable, whether it's a good opportunity for using the cryptocurrency system in that? So there's a framework that it comes up with. Let's look at that. So as with any other piece of new technology or novel new technology or new concepts, there are key questions that need to be answered to conceive, assess, and launch a new cryptocurrency project. So before you head on and create a new cryptocurrency idea or a business or a project, you need to answer a few questions, which are, first things to bear in mind when deciding a cryptocurrency project or looking at it or evaluating it is that it's now very easy and it's practically costless. Because of the new frameworks and new blockchain APIs that are available, it only barely takes about 10 lines of code to create a new cryptocurrency. You can create your own, just like that. Technology follows strategy. Understand that the technology is just a tool. You have to decide on the strategy. You have to create the business. So you have to decide how you're going to use that tool to create a new strategy, how you're going to come up with a new cryptocurrency system and what problem you'll solve. Opportunity must be assessed. You need to assess the added value of crypto in this use case. Don't just force a cryptocurrency into a problem when there is no real advantage coming out of it. You have to look at whether the use case, whether the scenario where you want to fit in that cryptocurrency actually will work better with it. So evaluate whether there's an opportunity to do so. So how do we do it? The essential pillars of the project are thus: the network, developing a complex network with new partners. Who are your clients? Who are your competitors? Who's going to be part of the network? The value exchange and ownership. How will you'll create new personalized means of exchange and own the assets? What will be the products? Stickiness. You have to make the customer experience better. The user interface for such a system would need to be really good, And fidelity, it needs to be very easy to use. It needs to be high efficiency, right? Process efficiency, gaining efficiency through instant automated decision making and sharing of information. It needs to have this. It needs to be able to make quick decisions. It must be capable of sharing that information about whatever it is, whatever tokens there are, very quickly. It needs to be accurate and transparent so that you can increase tracking and data gathering while also being transparent. So this is a framework that that the FaberNovel people have come up with to help us make a decision when we are deciding to launch a cryptocurrency for any business. So the first part is is the network. They say you should assign around 30 points. It's like a 100-point system, and each of these elements, each of these 1, 2, 3, 4, and 5 elements are given different points. So the highest amount of points are given to the concept or the pillar of network. So marketplaces, platforms bringing together different types of actors or, networks, 30 points for that. So willingness to share the IT infrastructure costs with stakeholders, willingness to engage other stakeholders involved in the transaction validation process. So you need to focus on the network, you know. So this is important. Value exchange ownership, need or willingness to create a liquid secondary market for token holders, requirement from users to take full ownership of their funds. That could be, a criteria. Maybe that's what you're focusing on. It's about value exchanges and ownership. Or stickiness, willingness to scale, optimize, or launch incentive customer retention programs, example, cashbacks or loyalty programs. So they're coming up with different ways in which it could be used. You could create a network out of it. You could create a network which will be acting like a marketplace, which is trying to bring in different players in the market. It will maybe be about sharing in IT infrastructure costs. Maybe it's about willingness to engage with other people, with the transaction validation for the, proof of cash or proof of work concepts, right? It needs to be sticky, which is the willingness to scale, optimize, or launch incentive customer retention programs. It needs to have data accuracy and transparency, which is another 25 points. It needs to pull accurate and reconcilable data sets, which is that the data that it has should be verifiable, or need a requirement for third parties to have access to these data. Data. Willingness to empower trust at the core of the project's value proposal. You need to let people have control over the data, have access to it. And the process efficient. Need to tackle payment challenges, example, banking setup, cross-border payments, micropayments, need to be able to do P2P. So these are different possible areas that you could focus on where your cryptocurrency system would be viable. Either you could create marketplaces out of it, or it will be about exchanging of value and ownership of things, like property, or it could be about creating new, loyalty programs, or stored value card systems. It could be about creating, accuracy or transparent records of something. It could even be about creating higher, more or better efficiency for person-to-person payment systems. You can go into any of these 6 areas. So you could create, any new system as long as you have these 5 pillars. So there's an example in the music industry called the Deezer coin. Deezer is, of course, a music streaming service. So token governing transactions and revenue sharing between listeners, artists, and right holders. How do they do it? So in the network case, they got about 25 points out of 30. What did they do? Marketplace. What did they do with the network part of it? They created a marketplace for the listeners, the music listeners, the artists, and the people who own the rights on that music. So the fee distribution between all these 3 parties, the listeners who pay some money to listen to music, to the artists, to the right holders, who then give some portion of it to the artists. So the fee distribution was part of such a network. Tokens can be used within Deezer's ecosystem to enjoy preferred conditions, higher quality of sound, or maybe even better versions of the song. So limited need for secondary markets, right? So they can do it there. Stickiness, opportunity to offer different rewards, live shows. So people who hold a token, a Deezer coin, can get live shows. They could then be used for other purposes, autographed, posters or whatnot, other stuff that they can buy with it. So you can give them more rewards. So potential token appreciation as the network grows, because more people will use it and there'll be more such opportunities. It provides data accuracy and transparency. Full points there. Why? Because it's a key for artists and right holders to rely on fair and transparent data set. Now, nobody's going to be able to steal someone else's music. Nobody's going to be able to make profit off of someone else's music. Now all of that is transparent. The records are right there. Every artist will know how many times listeners have listened to their piece of music, and they can get enough money for it. And the right holders will know who's buying their music, what is being more popular, what isn't. Plus, it's a streamlined process. It allows you to create different new business models. You can create a pay-as-you-listen model. You can create a pay-as-you or pay beforehand, or pay for a specific set, or even resale and make money off of it. So, if you evaluate the Deezer coin based on these 5 pillars, you'll get a score. So it's pretty cool. They're using it. If you look at the 5 pillars again that we're talking about, this is the analysis framework that is designed for any company who want to decide whether they want to use cryptocurrency in the system. So you can look at the same model and see how it fits in the case of Deezer coin. Take another example, the insurance industry. So MAIF community points, which is a token rewarding MAIF peer-to-peer digital customer support. How does that work? So the network, the digital customer support interface, bringing together people who are subscribing to the insurance company and asking for help, and other people who already own the the insurance, actually providing them help and support. Okay, so they own. Some people want help, other people are giving up help. The network part is done. It's like a marketplace. Value exchange. How's the value exchange happening? So the points redeemed to an MAIF customer support contributor could be used for MAIF perks and digital goods or services within the system. So there is no secondary market. You can't buy something else, but the points that you receive for helping someone out within this system, you can use it to buy different digital goods or products within that system. Stickiness. The additional service bringing MAIF community together, and it's bringing people, by helping them out. So people want to keep on using it. The stickiness is defined as reuse or incentive to use, right? So people are going to use it because it brings them all together, makes them a stronger community. It's transparent. The reward system is transparent because it's based on the answers whichever answers are preferred. Think of it like a forum, like an online forum. You ask a question, somebody answers. If you like the answer, then those people get more points or more tokens. So based on the answer scores that people who have asked the questions, they will get paid for it. And so it's pretty transparent. It's quality controlled because it's decentralized, because people decide on it. Let's take another industry, the entertainment industry, the INA reward token. So token rewarding the distribution, validation, and curation of media content. How does this work? Media archive marketplace, bringing together people who view media, people who are keeping records of it, and the creators of that media or content, the producers and editors. So people who are viewing it, people who are storing it and keeping a record of it, who have it with them, and people who are creating it. So it's decentralized data storage marketplace, because there are people whose only job is to store it. So there are people who want to watch, people who are storing it, and people who are creating more of that media. So the rewards could be used within the INA ecosystem, or you could convert them into euros. So there is a secondary market. You could convert them back into euros and use them there. Is it sticky? It's limited need for specific customers and incentivization programs. So not everybody is going to use it. It's limited. So it's not very sticky, but it's there. It has data accuracy and transparency. Yes, it does. There's a need to rely on clear and transparent data, so that the distributors and curators, people who are keeping that data in a certain way, or are keeping collections of it, need to be rewarded. So people who distribute it, people, in other words, who have it and to give it to other people, and people who categorize it and keep it. So process efficiency, the data curation and storage. Curation basically means it's like think of this system as a library. So people are maintaining libraries of different media content. They're maintaining it, they're categorizing it, they have collections ready. So there are viewers who want to view a particular collection. They go to the curator and they ask the curator to give them that particular set. They ask them like you would ask a librarian to find you a particular book or a set of books for a particular topic. So they act like a search engine. They help you find that stuff, curate that stuff, bring it to you, and you pay them using these INA reward tokens. And the media creators keep on creating new stuff for that system. So this is how it works. Another example, wines and spirits, alcohol. So illustrative example in this case is Pernod Ricard token. So transparent digital payment token offering rewards and revenue sharing among a network of whitelisted public relations partners respecting its cultures and values. Let's see how it works. So it provides strong IT payment infrastructure to the network of stakeholders. Fees can be redistributed instantly within the network of participants. So it's a public it's a PR payment token. My bad. It's Pernod Ricard. So it's not public relations. Pernod Ricard. So they pay for the network infrastructure. They pay their partners, their suppliers and distributors in the points within that system. The network participants use that token to take discounts and so they're basically using a cryptocurrency within their own network with their customers, with their suppliers and their vendors. The blockchain lets them have records and allows them easier financial audits. The payments are by design accessible by everyone that has a simple internet connection. There is no fees involved. So it's a system that is being used by these alcohol company called Pernod Ricard, and they actually use it to pay their own suppliers, and their customers use it to buy their product, and it's like a closed network system using blockchain so they're basically using it in more of a money format. So another example, in the beauty industry, L'Oreal uses it for L'Oreal loyalty programs. So it's interoperable and tradable loyalty programs, rewards, coupons, and gifts. So it's like a gift cards and reward cards and loyalty cards, only it uses cryptocurrency. How so? Network. Strong network of brands that could support a lot of the IT cost and benefit from a group-based interoperability network program. So it helps them that way because it brings in a lot of advantages, because then the customer can get loyalty points in return for something. So liquidity enabled thanks to secondary markets, so full ownership of loyalty points. So L'Oreal can pay you back for whatever you're buying from them, and or you could buy from them these reward cards or coupons and gift cards that they can pay you back in those. So network participants are incentivized to use the token within the L'Oreal network. So once you get those reward points, you're going to buy more L'Oreal products. So there's a lot more advantage there. The more of their products you use, the more points you get, the more advantages you get. So the rules are embedded in the system, which allows more accounting and evaluation of who's using how many points and what are they used for. There's no issue of payments. It's very easy, and there's no transaction fee involved because the banks are not involved. So L'Oreal is basically incentivizing people who are their customers to keep on using their system. That's another example. So that's pretty much it. So if you look at it, what your takeaway from this entire this last part should be is that when you're going to create a new system, a new cryptocurrency, you need to look at how it will probably solve these three things. How it will probably leverage these three things. One, that it is now easy and costless to create a new cryptocurrency system. Two, you must understand that the technology is a tool. You need to decide on the strategy, and you need to look at the opportunity and decide on how you can use that opportunity to create and use cryptocurrency for that opportunity to be truly leveraged. And for that, you need to look at how your cryptocurrency system will solve these 5 things, or how it will handle these 5 things. Number 1, I'll repeat it again in summary, is network. How you're going to bring in different parties, different groups of people into this system, whether it be to share the platform, become a marketplace, find each other like a marketplace, whether it will be to share some infrastructure costs, whether it will be for validating and verifying the transactions. Then you need to look at how this will help exchange of value or of ownerships. Will they be able to use those tokens in a secondary market? Will they be able to convert it into some other fiat money or some other form of money or value to use it elsewhere? How will they be able to take full control of their funds, of the money that you're creating? How will you convince them to keep on using this system or incentivize them to continue to use the system? How will you allow, or how will you create the system to be transparent and give you accurate information about who has access to that data and how they're going to use it? In other words, it needs to be transparent. How transparent will your system be? And how efficient it would be? Will it be able to allow various payments to happen across systems? Will it allow micro payments, which are very small amount of payments? Will it enable quick and fast person-to-person payments? And after you've come up with a potential answer to these questions, or you can look at these pillars and decide, and then look at an opportunity and see if these 5 things are something that your particular strategy or your business idea would be enhanced with if you were to use these 5 pillars and evaluate them. So these examples in the music, insurance, entertainment, and alcohol, beverages, and beauty industries can be used. So that's pretty much it for the future of money. Thank you.